Good morning and Happy New Year. It is January 1st, 2021, and 2020 is over, so that's great. And 2021 is brand new, a little baby's bottom. I think we're going to learn that this is not going to be the easiest year either, but things will get better, and there's light at the end of the tunnel. So why don't we get started? Every year I do my fearless futile forecasts. I call them futile because nobody ever gets them all right. A lot of people don't even get them mostly right. If you take a look at the big investment bank predictions, they're almost universally way off every year. I was just reading Goldman Sachs' recent note, and they showed how often they changed their forecast. It was like 20 times last year. So they changed their forecast nonstop. So my question becomes, how important are forecasts? Well, I think the importance of forecasts is to give you a framework to work from and then adjust to. As things that you thought might happen don't, or they happen more, or they happen less, or they happen differently, or something completely different off the charts that you didn't even think about happens. But it's a framework for helping you understand possibilities, and you can always add to that forecast. Goldman Sachs does it pretty much every other week. So I would tell you, don't get stuck inside of your forecast or my forecast or anybody's forecast. And that doesn't mean be a chaser of the stock market, because if you chase, inevitably, unless you're a very, very good trader, you're going to get caught by a limit down day or some bad event, and you lose everything that you made. So when you chase the market, you have to be a very technically driven, shorter term trader. And I don't think that's what most people are good at. In fact, we know, tax returns prove it, that around 80% of people who trade would have been better off in an index fund. So if your benchmark is the S&P 500 or QQQ, and it probably should be QQQ because that's the better index for the last 20 years, almost every rolling period that's longer than 3 years. You ask yourself a question, how much time should I be putting into trading? And if you're not handily beating QQQ, the answer is not much. I should be looking at my account a few hours a week, not a few hours a day. As we work through the different scenarios, I would tell you, be very careful on how you trade, because I think a lot of folks, including myself, got hurt trying to speculate when this stock market rally was going to end. By all rights, on the fundamental side, stock market shouldn't be as high as it is. Even projecting out earnings 2 years, much less a year, but 2 years. Let's give the historical context some benefit of the doubt and say, okay, coronavirus, this pandemic was so severe that let's project earnings 2 years from now. Let's give ourselves a little wiggle room. Even doing that, the fundamentals don't support the stock market valuations. So we'll get to that in just a second. So here's your next president of the United States. Should be confirmed this week yet again and inaugurated in 3 weeks. The risk of stagflation is very high if the government stays divided. So here's my first big set of ideas. The first big pivot is this week. On Tuesday, there's an election in Georgia for 2 senators. If the Democrats win the Senate, we should expect more fiscal stimulus and a build from the bottom up and middle out approach. That's a slow process. It takes years. The Fed will still stay involved, but it'll be less than it was in 2020. Probably see a higher capital gains rate for people making a certain amount of money. The number that's been thrown out there is $1 million, but I think that you probably see it much lower. I think the capital gains rate will just be the income tax rate once you've earned about $140,000 in capital gains. So the very small investor, the person that has $10,000 and $20,000 and $30,000 of capital gains in a year, or maybe sells a property that's not their primary residence and make 50 grand. I don't think those people, the people who flip a property or trade in the stock market, I don't think you have to worry about your capital gains. But if you're making 6 and 7 figures in the capital markets, your capital gains rate is just going to become the income tax, because really that's your income. So why would you get a break if you're a professional in the financial sector? So that's what Joe Biden has promised. I think that he delivers that quickly if the Democrats win the Senate. That would cause some big investors to really rethink what they're doing. But given that there wasn't a ton of selling at the end of 2020, we'll see how that impacts 2021. They may or may not be sellers if they already know, well, I already missed my chance. Because I would expect that this tax increase to be effective for 2021. Under a Biden presidency, the dollar probably initially weakens, but then pretty quickly firms. Been talking about that for about 2 years now. Is that if you take a look at the dollar under Obama, Biden, and Biden's more of a dollar bull than I think Obama was, you're going to see the dollar get firm pretty quick. So that would mean a managed approach at the Fed. Jerome Powell only has a year left. He's not going to get the job again unless he does what Janet Yellen asks him to do. I'm not sure which way he goes. I think he likes the job, so maybe he's a team player. We'll find out. You're also going to see a lot of corporate loopholes wiped out. That's good because companies like Google and Microsoft and Apple and Amazon and all of these other companies that report all these earnings to their shareholders and yet don't pay income tax. There's something fundamentally flawed there, not only from an ethical standpoint, but just economically, it doesn't make sense. I would expect a correction this year that's of some significance, and then a consolidation, with the stock market probably ending a little bit lower if the Republicans hold the Senate. I would expect less fiscal stimulus. I think we're already seeing that with the way the current bills in the House and the Senate are playing out. Much more reliant on the Fed to keep the economy afloat, which means we're stuck in trickle down through the markets, which is good for speculators, but I would still expect more volatility. Taxes remain the same. The dollar heads to that lower range, putting us on the brink of a financial crisis. We see slow economic growth, similar to Obama's second term when Mitch McConnell blocked him on everything. So initially we get a rally, followed by a reality correction, and then possibly a financial crisis if the dollar gets too weak. But my prediction is this. The Democrats are going to win on Tuesday by a whisker. The stock market will correct to around 300 on SPY and 240 on QQQ at some point this year, probably earlier than later. We'll see a rally back near the highs, but not quite. And then the market will settle back into a year-end correction as people retrench and manage their taxes. I would expect 2021 to end around 350 on SPY, so a single-digit percentage loss, and about 270 on QQQ. Same thing. 2022 to 2024, as the economy recovers, people get back into the labor force, they start contributing to their 401k again. Joe Biden gets his own Federal Reserve chief, or Powell, playing ball. I think you see SPY rise to 500 by the next election and QQQ to 450 by the next election. But what if I'm wrong? Well, if Republicans win by a sliver, or it just doesn't matter who wins, the same things happen for the most part, but in different orders. SPY probably rallies to 400 quickly if the Republicans win on Tuesday. QQQ, right, goes up to 350 short term, but then we still get that same correction. Then we see a rally back to near highs, but not quite. And we end the year, I think, probably a little bit down. I do think that 2021 will be a little bit above water, a little single digits above water, single digits below water. If the Republicans win, maybe 2021 is a little bit above water, and then the correction comes next year rather than this year. So just a different order. Now, the wild card is, what if the dollar does get crushed? If the dollar gets crushed, then this is out the window. And then these numbers are probably where we end up, or maybe even these numbers by 2024. It could be a 3 or 4 year bear market if the Republicans win on Tuesday. Well, again, why? Because we know, as we've studied over and over again, if the dollar gets too weak, which is what would happen if the Fed is charged with handling everything, we'll get a financial crisis, especially running the massive deficits because we don't have the ability to raise more revenue through higher taxes on the corporations and the 1%, the professional traders. So this, again, goes out the window if the Republicans win. and you have to pick out one of these other two levels. It could be a very choppy 4 years if the Republicans win on Tuesday. That's my belief. And right now, we're seeing a stock market as both delusional and leveraged. In my mind, we're seeing components of both 1999 and 2008, which means that you need some corrections or you need some consolidation that takes a little bit longer time as earnings catch up on the PE ratio. 2015 and 16, we know the market basically chopped along sideways for about 21 months. I could see that sort of thing happening for 9, 10, 11, 12 months again. I have a hard time seeing the market chopping sideways for almost 2 years, but it could happen. You could get all of 2020 into towards the autumn of 2021 with the market chopping along if certain things play out. So we have to be very aware how dangerous this is. It doesn't take much of a shock or a disappointment or the V turning into an L on the recovery or the K not being as capital K and becomes a little k for things like this to matter. Margin debt's at an all-time high again. Alligator jaws close. Certain parts of the market have mean reversion. Margin leverage is one of them. And that margin is mainly the little guy who has become, this is a different use of the word, the marginal buyer. That extra buyer that drives prices up. And these small traders are doing it with call buying. Not only have you seen a doubling of the number of trades made by small traders in the last 2 years, but these are leveraged trades. So they have a bigger impact. If those trades unwind, as I've discussed before, you get a heck of a down month, or maybe two. It'll happen fast, it'll happen hard. The smart money has been trickling out of the market. They buy back in for little rallies, and then they sell again. It's happened 3 times. It's about to happen again, and it looks like the smart money is going to start selling again. Valuations are way up here, and as we discussed last week, even at low interest rates, you really only can make an adjustment to about here, to about the second standard deviation. So we're way above the third standard deviation. It's very rare that we see prices like this. In fact, only the second time ever. And even adjusted for interest rates, it'd still be about here. So if interest rates were 3 or 4%, we'd still be overvalued. Not as much as this, not as much as 1999, but still second most in history. Right now, we're the most overvalued in history. This is the one that has made more and more sense to me as I get to know businesses from the bottom up. You ask a very simple question. Which one is it cheaper for me to do? Is it cheaper for me to buy an existing business or start one from scratch? And almost universally right now, it's cheaper to start a business. That's why a lot of these SPACs are out there, because they're buying companies that don't really have a big public valuation yet. Take a look at some of the favorites that I've pointed out that have tripled like right out of the box. I think a lot of them come back. I think a lot of them suffer massive execution risk. And eventually, to defend the dollar, we'll have to print fewer of them and let interest rates adjust. Doesn't mean that the Fed will change short-term interest rates, but the market will change everything else. So if credit becomes just a little bit tighter at the corporate level from the loosest in history in the last 9 months since the CARES Act, what happens to a lot of corporations? What happens to the margin that's in the stock market right now? A couple years ago, I started talking to you about Cathie Wood, how innovation is driving everything. And you have to be on the right side of innovation as an investor. Tech and communications, industry that uses technology well, consumer discretionary, alternative energy, biotech on the one side, most of your money. And maybe around 20% of your money over on this side, maybe 30%, 30% on this side. Your Reits, your gold and your cryptocurrencies, materials, alternative energy, alternatives again, like private equity. If you're an accredited investor, I can help you with private equity. I can tell you who I would talk to. The problem with this side is that these are capital intensive industries for the most part, your REITs and your materials companies. So you have to be very, very careful in your selection. You have to truly understand the supply and demand dynamics and the balance sheets. Gold usually is speculative, But now we're starting to see massive supply and demand imbalances, with the biggest miners being the best plays. And then there's a handful of junior miners that the big miners might buy. If you can figure that out, you can make money there too. Then all the in-between miners, they're very price dependent on gold. The giant miners, though, because of efficiencies of scale, your Barracks, your Newmonts, they're the ones that do the best. And there's a handful of other big ones that do pretty well too. But when you just look at balance sheets and you look at the quality of operations, for the most part, bigger is better in gold miners, right? And again, if you can find a small one that's going to get bought out, they'll be okay too. Your REITs, I've been spending a lot of time the last 15, 16 months getting into the REITs. I've looked at buying a couple of malls, putting together partnerships. I've taken a look at buying an office building with a guy who's pretty well established in that industry. And the problem is that a lot of buildings are very, very expensive to convert or redevelop into what we really need. Office buildings, because of the plumbing issues, are monumentally expensive to convert into mixed use. Malls, because a lot of the buildings are old, even if you build around them, what do you do with the big old building in the middle? There's a lot of tearing down that needs to be done. There's not much money in tearing down. It costs you money to tear things down. And then you're 2 or 3 years out from having rents again. So it's a tough equation. You need government help. You need the banks to work with you. But this barbell is the one that works. If you take a look at Kathy Wood over at ARK Investments, which has been the top performing funds for a while now, they're using this. This is what she's invested in. Everything else just kind of gets sprinkled in along the way because it happens. And especially for us, if we're using ETFs. If you're using ETFs, you're going to get some things that you really wouldn't like if you're going to pick everything individually. But how many of you can pick out 50 or 100 stocks and understand what each one is doing? You have to go with some ETFs to build your asset allocation, and then your best idea is to add alpha. There's no point in buying a stock if you don't think it's going to really beat the market hard. So one of the big questions is, will America be Japanified? And there's a lot of circumstantial evidence that it will be. But there's a couple of big things that say that it won't. Everybody points to Japan's debt and how the United States is catching up. But Japan is much, much older than the United States, and they're not resource rich. The United States has a younger population and all the resources that we could possibly need. And we're learning how to use them now better. One of our SPACs in rare earth metals, going to process them here rather than shipping them off to China. We have all the natural gas that we'll ever need. Bank of Japan and their pension fund combined for about 45% ownership of all Japanese equities. So I guess a question you should ask yourself is, will the United States government or Social Security or the Treasury or the Federal Reserve actually start to buy equities at some point? I hope the answer is no. And I think the answer will be no. Because if that happens, the rigging of the system will have been complete. And eventually, we know that those sorts of things fail. And they fail spectacularly when they fail. And the recovery from that sort of thing could be monumentally bad. Now, in the past, I've thought that maybe we should put 25% of Social Security into a Russell 3000 fund. And I don't know that that's a horrible idea if it's scheduled and it's gradual and it can't be manipulated. But if we did that, we'd have to say the Federal Reserve can't participate in the stock market. How do you have capitalism with government owning 45% of the businesses? How different is this than China? Just because we don't call the Japanese communists, they certainly have become socialists in this aspect. And their quality of life hasn't changed in 30 years. And now, if you take a look at the statistics, it has gotten worse. Free markets work when the government maintains the freedom. What do I mean by that? Money generates more money and power generates more power, and you have to control those things. That's why we fight back against monopolies, because it turns into hoarding and it stifles competition. So maintaining the level playing field is a vital role for the government, but it's also a balancing act. So we take a look at, say, Facebook, which has clearly been bad for competition. We have to ask the question, should they be forced to spin off, say, Instagram? I think the answer is yes. Could they stay connected by some sort of mutual logging in function? Sure. Facebook is used to log into all sorts of websites. Why wouldn't Instagram be one of them? But at the end of the day, you're losing the ability to advertise to different people at different prices because of the way Facebook controls those things. Same thing with Google. There's been a little bit more done to make Google more competitive, but not much. And they find ways around it. Should there be other search engines? Yeah, probably there should be 2 or 3 more. Does that mean that Google should have to share their databases or their technology? I don't know. I don't know the solution there. I think that's a harder one. They haven't really been on a buying binge to wipe out competition. They've just outcompeted. I'd keep an eye on Europe. Europe's big market, 3rd biggest in the world, the 3rd or 4th biggest in the world, depending on how you measure. Their rules matter. Just like in the United States, the rules on climate and the environment that come out of California matter because they're such a giant economy. Companies don't want to have 2 standards. And when governments get too involved, they start to cheat. And that's what Japan just did. Pension funds stopped lending out securities for shorting, which I think is reasonable if it's a permanent solution, right? If they never lend out, fine. Or if they always lend out, fine. But the back and forth, it's a manipulation of the market. Why would they do that? Because they wanted to sell some of their stock. This is as bad as the Saudi Arabians changing the supply of oil after they've made bets in the oil market, which is what they've done twice now in the last 5 years. And I'm sure it's going to happen again. So in the United States, federal debt, because of the Great Recession and the pandemic and the general trend in demographics, is going to go through the roof. We're already at World War II levels. We're headed into the stratosphere. The government starts to have a hard time financing its debts when it can't afford the service payment because interest rates go up or the currency gets too weak. That's why I say it's pretty clear that if the dollar falls off a cliff, like a lot of people talk about, we have a financial crisis. And in that scenario, Bitcoin might go to a zillion. I don't think that's what's going to happen. So let's talk about debts and currencies and where money goes when we have deficit spending. For a brief moment, we essentially balanced the budget. And it's gotten worse and worse and worse. Financial crisis, pandemic, and this supposes no major problems. What if there's another recession? Red line goes up, blue line goes down. Deficits goes more and more and more up. In a recession, velocity of money falls off a cliff. We've already had a long-term decline in the velocity of money. Again, this is demographically driven. The boomers saving more for retirement and spending less because they raised their kids in here, right? They raised their kids, their incomes went up and peaked, kids moved out, and now they spend less money. Financial crisis drove it down again. People save more, spend less, falls off a cliff. Will it rebound back to this level? I sure hope so. I sure hope we get velocity of money back in this 1.4 to 1.6 area, because if it's down here, we're doomed. That means there's virtually no economic activity, no growth. And since the financial crisis, we've put on more debt than we have economic growth. Clearly not a long-term equation for success. How close are we to a financial crisis? Again, if we let the dollar collapse, we're close. U.S. Treasury yields can't go much lower. You go a little lower, 0.5% lower, maybe a point, right? They could actually go negative. And the real rate, when you subtract inflation, can go quite a bit lower. What if, earlier I said, the risk of stagflation is very high? What if the recovery of the economy isn't as nice as we want it to be, but the price of things from disrupted supply chains and the printing of money goes up? Milton Friedman taught us, and other economists have taught us, that inflation is a monetary event. But we feel it when the economy somehow triggers the price levels that we pay to be higher in real terms, when we lose our purchasing power. So we haven't really lost our purchasing power because we haven't fallen off the cliff yet. That doesn't mean that we're not looking over it, that a gust of wind or a gentle nudge from a recession couldn't make things worse. And relatively speaking, The United States is in better shape than, say, Europe or Japan, probably even China. But what if those four economies fell into recession again? And supply chains and trade wars drove up prices because of the monetary policy that tried to trickle down into the economy from the top down. Well, here's the problem. We know that virtually all the debt created since the 80s, total net worth held by the top 1%, has gone to the richest 1% of the people. And then the difference here from about 26 trillion, 27 trillion of public debt and the $35 trillion of wealth held by the top 1%, that's a $7, $8, $9, $10 trillion difference in here right now. How big is the Federal Reserve balance sheet right now? About 7 trillion. So you should add the Federal Reserve debt to this. You see that all of the generated debt, which has primarily been happening because of tax cuts to the super wealthy, with a little trickling down to us in the investor class. And then we stupidly vote for that because, I made an extra $9,000 this year. $3,000 in taxes I didn't pay, whatever. Virtually all the wealth transfer in this country has gone to the 1% through debt and what the Federal Reserve is in debt for now. The numbers are almost identical. That can't be a coincidence, can it? The deficit spending through tax cuts to the rich, and the tax cuts do go 80 to 85% to the rich. And I say rich, I'm just saying the top 1%. Nobody else qualifies. Because the difference between going from the second percentile to the first percentile is a zero. Not 20 or 30 or $50,000. This is a zero. It's going from $1 million to 10 million. A lot of millionaires out there. Maybe with 10 million, 20 million, 30 million. That's who's in this group. You don't count at $1 million or $2 million bucks. We don't count. We get the schnibbles from this. And you're seeing populism on both sides. Trump's movement was populist. The Democrats' movement is populist. Weirdly, Trump and the Democrats were on the same side of this last stimulus issue. At what point do we have a gigantic reset? I don't know. If the Republicans win on Tuesday, it might be a lot closer than I thought. Might be in the next 4 years. So if the dollar falls out of this Goldilocks zone, and this chart's a few weeks old, a couple months old, it's down here now. I told you if it goes below this line, it falls down into here, we start getting very close to a financial crisis because we won't be able to finance our debts without pure money printing. There's two ways to do that. You can do modern monetary theory and just print perpetually, which, given how weak the dollar is, it would just wipe out the dollar. I would say that I guarantee stagflation if we go to modern monetary theory. What I think we should do, and what I think is going to happen, is at some point, hopefully sooner than later, because the numbers will be smaller and easier to manage, but probably later because we're all cowards, and our politicians are cowards, and the population is unsophisticated when it comes to economics. Everybody's just thinking about the next year rather than the next 10. If you truly want to get ahead as an investor, think about the next 10 years, not the next year. If this falls off a cliff, we're in big trouble. This is the last time it happened, and we got the financial crisis. It would be worse next time. In that scenario, Bitcoin could go to the moon. But here's what I think is going to happen. What if the government says no to Bitcoin? And what if the United States and the European Union, the ECB, European Central Bank, introduce a digital dollar and a digital euro that use blockchain to facilitate instant, almost free transactions across borders and currency to currency, and it's pegged to inflation. So let's say we started with 10 trillion digital dollars and said we're going to increase the supply of the digital dollar by whatever our inflation rate is. It's not discretionary. Inflation is 2%. We'll add 2% to the digital dollars. They could come up with a number of different formulas. They could combine inflation with economic growth, do a real number of some sort. They probably want to use the higher number, but it would take very little to destroy Bitcoin. And here's why the government might want to do it. Not just to preserve their control, because we know that there's big investors and institutions that are starting to hedge using Bitcoin. And they're just nibbling in right now. And just that little nibbling in has caused Bitcoin to go up like a commodity. It's not a freaking currency. It's a casino chip. And they're trying to replicate a mania. The people who hold it now, they're just trying to hype it up to get it to spike. This Sailor guy is a criminal. A lot of these people involved in this pump and dump, which is what it is, are criminals. They're white-collar criminals playing on you. Now, down here, I said maybe put a buck or two, 1 or 2% of your bank savings into Bitcoin. And look what it did. And now people are asking me, should I buy Bitcoin up here? Why is it that when I say something down here, you don't ask me why? But after it goes up 1,000 or 10,000 or whatever, why do you ask me up here? When I say down here to buy Bitcoin or something else, that's when you should do the research. Don't wait for it to go up from 14,000 to 30,000. Oh, maybe I should buy it now. Look at that chart. Does that look like it's right? I'm going to put out my book list, just one big list. I've got about 20 books that if you were going to read a couple books a month, I'll give them to you. And I recommend that you buy the books and mark them up a little bit because we know that Audible isn't good enough. I canceled my Audible subscription over the weekend or last week. You can listen to books all you want. And there's certain stuff you can listen to in the car. I prefer Sirius. Audible doesn't give you the in-depth knowledge that actually reading it. It has something to do with the eyes and the way it connects to the brain. Read the book. Don't be lazy. What you're going to find in some of these books is how manias have worked in history. This is a textbook example. I've been talking to this guy, Paul Gambles, about it. He's putting out a paper coming up. So here's my very succinct argument in 280 characters or less about Bitcoin. The Bitcoin bulls have a misunderstanding. It'd be very easy to create a digital dollar, digital euro, digital yuan using blockchain to guarantee the payments. You pay that fraction of a fraction commission to the people who keep the ledger. And it could be a combination of all the banks and financial institutions that do it. So every sanctioned bank would be allowed to take part in the ledger. And why would they do it? It's extra money for them. You're supporting the banking system. It's a quid pro quo. Don't use Bitcoin, use a digital dollar instead, and you'll be the keepers of the ledger. It will wall it off a little bit so that there aren't all of these incursions, all these hacks that we've seen. If you don't think the government can do that, you're insane. If you don't think that they're motivated to do it, you're wrong. If you don't think it's going to happen, you're not paying attention. The digital dollar, the digital euro, the digital yuan, they're all coming. And Bitcoin's going to crash. Can it go all the way back to zero? I don't know. Take a look at Ripple and some of the other cryptocurrencies. They've crashed. Bitcoin is the one that's getting pumped and dumped. It's the chosen one. It's digital gold. It's the future of money. It's an Austrian economist's dream. It's the crypto anarchist reality. Screw the government. Screw the central banks. We'll control it. It'll be libertarian. It'll be democratic. Those are the words they throw out. Here's a word I'll throw out. It's a farmer's word. You know it well. I don't see it in the chat just yet. It's bullshit. Bitcoin, mark my words, after this spike, there's going to be an intervention. And it's going to drop so fast and so hard that people are going to get wiped out in days. Where does all the money go from the Bitcoin? If corporations and the super wealthy are trying to pump it up, taking money out of the normal system, what do they not do if they can't? They don't put it into Bitcoin anymore. Somebody says ARK likes Bitcoin. Kinda. It's a trade. It's a trade. That's all it is. And you don't know if she still owns it. I look at their ledgers every single day, right? Because they put them out. I've told you that. Blockchain's important. Bitcoin just proves that the governments can do it too. And if they tie it to CPI, now all of a sudden, it's a store of value, which is what people are trying to say Bitcoin is. Money has three functions: unit of account, medium of exchange, and store of value. That's the definition of money. Bitcoin isn't a unit of account. How could it be? With that chart, how could it be a unit of account? It's too volatile. Is it a medium of exchange? Anybody buy anything with Bitcoin over the holidays? Maybe a couple of you, not many. 80% of the Bitcoin is held by 2% of the accounts. Is that egalitarian? Is that diplomatic? Is that democratic? Or is that just more of this bullshit? So there's my biggest prediction over the next several years. Bitcoin's going to get crushed. Might go much higher first, but it'll get crushed eventually. The governments and central banks will see to it. They have the technology too. What happens when the $6 million man meets a mortal? Bitcoin's the mortal here. So I don't see modern monetary theory. I see helicopter money. Solving problems, one-time devaluation, then the dollar gets much stronger. Do we have a crisis first? I don't know. Probably. Especially if the Democrats don't win on Tuesday. Because Mitch McConnell's going to block everything. He'd rather sabotage the country and satisfy his very, very wealthy donors than anything else. Because you tell me, if we can pump $4 trillion into the banking and corporate finance system this year, last year, why can't we give another $500 billion to the American public that makes under $100,000 a year so they can get through this final leg of COVID? Is that populist? Is that egalitarian? Is that democratic? As an investor, you need to understand this barbell. This is where the relative winners have been. And this is your hedge against a lot of things. And I think that crypto is just about done on the Bitcoin side. When they introduce the digital dollar or the digital euro, you want to buy it immediately if you're allowed to. That would be where you put money, especially if it's pegged to CPI, like the whispers say. Remember that scene in Wall Street, the movie? Bud Fox, he's talking to the older gentleman, makes the whistle sound with the little birdie. Poof, it's all gone. That's what's going to happen to Bitcoin, because digital dollars, digital euros, and digital yuan are coming. And that will help facilitate the great reset of debt that we need, must have, because you create a shadow currency system that has rules and you allow everybody to shake out at the domestic, local level. The digital euro would be a godsend for Europe, because then Greece can do its own thing. They can all have a local currency and then participate in the digital euro if that's what they want to do. Certain countries in Europe need massive devaluations yet. And if a lot of them are tourist countries and the families sit on some wealth, that helps everybody else catch up. These ideas are pretty self-evident if you study them for 20 or 30 years, which is what I've been doing. Since the late 1980s, I've been studying this stuff. And yet, we keep voting for the dumbest things ever over and over and over again. Because as Wisconsin Governor Scott Walker once said, divide and conquer is working. And that's what politics has become. So you have to decide over and over and over again which side is really good for you. And I would suggest that whoever supports this transfer of wealth, of sovereign debt, which falls to you and I, to the 1%, aren't on your side. So whether it's AOC, who just wants to print money forever, or it's some Republican presidential candidate or senator who just wants to give tax cuts to the wealthiest and some schnibbles to the rest of us in the investor class, this is not sustainable and eventually will cause massive, massive pain. We almost figured it out when Bill Clinton and Newt Gingrich compromised. Is compromise possible? Joe Biden's trying to talk a good game. Think Mitch McConnell's going to compromise? I don't know. Maybe a little. But the Democrats win and it goes 50-50 in the Senate. Now it becomes a lot easier for a couple of Republicans to just vote for infrastructure, to vote for some things that revise the system a bit so that this number goes sideways, right? 1% don't need more money. Their wealth should stay the same for a decade so that everybody else can catch up. They'd still be pretty rich. Ask Elon Musk. His company hasn't made money yet except for selling tax credits. Tax credits? Huh. Where does that come from? So what I would say to you is that there's going to be winners and there's going to be losers. The big crisis that's out there that's clearly looming, we should worry about. You're going to need some inflation hedges. If on Tuesday, the Republicans hold the Senate, I'm going to buy a lot more materials and gold. I don't think I'll buy Bitcoin, though, because Janet Yellen is still the Treasury Secretary. And I don't want to own anything that doesn't throw off a ton of cash. I want subscription businesses. I want high margin industry sector ETFs. I don't want capital intensive companies. I don't want to own Reits where they have to do massive expensive redevelopments. I might buy a construction company though. I don't want to own big pharma really, but the companies that have converted to be more biotech, maybe. But what I really want is those $2 and $5 and $10 billion biotech companies that big pharma is going to buy. Do I want Enphase, which has gone straight up, right? I bought that one under $10 a share and I sold it at 42 or something. And it's 180. Do I want Enphase? No, I don't want Enphase. But I might want SunPower or TAN because those industries are going to do great. Clean energy is going to do well. In fact, it might be the fastest growing industry in the world over the next decade. I think probably it will be when all is said and done. We've got 12 or 15 countries now saying that no more gasoline vehicles after 2030. For sure don't want to be in oil. If you own oil stocks right now, look into the future 5 or 10 years. This rally in oil stocks, this is your escape. Sell every single oil stock you own. Natural gas, there's an argument for it to go up in price. The problem is that the companies are all in debt. So the bet on natural gas is pipelines, or if you want to speculate in the futures market, you can do that. If you don't know how, don't do it. And the ETNs suck. So you have to have a once removed play, and for me, it's the pipelines. Which, because as we learned at CES a year ago, and the new one starts in a week, hydrogen is going to play a role in large transportation. Because we're not going to see a hydrogen build out like we have the gasoline stations all over the place. But we could see hydrogen where fleets are parked, truck fleets, right, at depots, at truck stops. Trains can run on hydrogen real easy. And that hydrogen is going to be moved. Gas pipeline companies already have the rights of way, and the pipes are actually can be converted. The oil pipelines have a lot more work to convert, so they're second best, but why bother with second best? Especially since their contracts are really going to screw them up during the transition, right? Because they got to still move the oil they're on contract for. Consumer discretionary investments are going to always do well if you pick the right ones. Roku, Apple. You go through the list, old or new, big or small. The winners are going to be winners, just like they always are. The communication companies, right? We're going to have 4 big 5G companies when all is said and done. It's a mature industry. How are they going to make more money? They're going to raise rates, pay off debt, throw out a dividend. They're okay. But one of them owns an entertainment company that's just getting off the ground. Take a look at Disney's chart and then compare it to AT&T's. Could AT&T follow in the path of Disney? I don't think it'll do what Netflix did, but it wouldn't take much to move the needle for AT&T if Netflix stagnates, which is what it looks like is happening. Very simple relationships. All the things that Kathy Wood's been saying, I've been saying it for the same amount of time. If you want to build your own portfolio for the 2020s, this is the barbell. Morgan Stanley is telling it to you. Goldman Sachs is telling you. Kathy Wood is telling you. Stanley Druckenmiller is telling you. Warren Buffett is telling you. I'm just repeating the message. Get your 4 or 5 ETFs that you're going to be mostly in, then pick out your 12 to 30 stocks, depending on how much time you have, to add alpha. There's no point owning individual stocks to try to make about a market return. Why would you take single stock risk to make about a market return? Oh, I'm going to make the S&P 500 plus a little bit better dividend. Who cares? What if you're wrong? What if their accounting goes bad? What if a competitor does better? If you don't think you have a top 10% stock, don't own it because the gains are skewed to the edges. That's why 1% of the poker players win 80% of the money. That's why 1% of the investors make 80% of the money. Don't screw around with stocks in here. If you're going to buy individual stocks, you're going to get a few of these through your ETFs. That's your diversification. That's your what if I'm wrong. Focus on this end and this end. This is where the big money is.